reaction to the Fed's decision to hike the discount rate. And then today, Asian markets are bouncing back. Is the nervousness, at least in Asia, gone about Fed policy?
I think that it is reasonable for investors to really discount the Fed discount rate increase and conclude that it's not such a big deal. And there are three reasons for that. First, the Fed has actually begun to remove some of the extraordinary liquidity measures already in June last year, when they reduced the sizes of the term auction facility auctions. Then in November last year, they said that the tenor of the discount window will be reduced to 30 days. And last week, they cut it further to overnight, and they increased the premium over the Fed funds rate target. So this is only part of a process that had already begun earlier last year. Second, the Fed itself is insisting, not only in its statement, but also through following speeches of its members, that this is not a start of a real tightening. And finally, the discount window has not been really used much recently, so the increase in the rate is not impacting market rates. And therefore, it shouldn't really matter for market prices. And I continue to believe that the Fed funds rate target will not be increased until the second half of next year.
Dariusz, it's Karen here. Good morning to you. I'm interested in some of your recommendations and the way you think it's very different from Q1, Q2. An example of that being the yen you think will be the weakest of the G10 units for the rest of Q1, but perhaps Q2, Q3 will be a different scenario.
Well, in the short term, I believe that risk appetite globally will continue to recover from the Greek debacle, from the concerns over Chinese or US policy tightening. Global growth will keep accelerating and mood should be positive. This will favor short selling strategies to finance the carry trade, and those strategies will hit the yen and also the dollar, but the yen probably even more. That's why I believe the Japanese currency will be the weakest in the short term. But beyond that, probably starting in the spring of this year, markets will begin to be seriously worried about the risk of double dip in the G3 economies, which I think will come when fiscal stimulus packages expire towards the end of this year. Markets usually anticipate swings in macroeconomic trends 2 quarters in advance.
Dariusz, if I could just come in here very quickly.
Second quarter they will be hit.
Despite the stabilization we're seeing in equity markets right now, are investors perhaps trying to tell us that they're not quite ready for this accommodative policy to be withdrawn, that they want these easy money conditions because the economy still isn't on a durable footing yet?
I would definitely agree with that statement. It seems that whenever a major central bank makes even a minor move in withdrawing some of extraordinary measures, be it liquidity or the RRR in China, markets react very nervously. And this is telling us that the rally of last year has been largely caused by super easy liquidity conditions and not so much by any belief in a lasting improvement in macroeconomic fundamentals. So now all the professional institutional investors are really concerned that when this liquidity begins to be withdrawn,
Dariusz,
then fundamentals are not there.
We have to take a quick break right now. I'm so sorry. We have to take a quick break, and we'll be back with you in just a moment. Stay tuned.
Dariusz Kowalczyk, Chief Investment Officer at SJS Markets, joining us again live from our Hong Kong studio. I'm curious about what you're telling investors when it comes to the handling of the euro, because it does seem as though there is a potential for a lot of news flow to influence the currency, yet at the same time there's this fundamental problem where there are so many shorts still on the euro and so many long bets on the US dollar.
In fact, the fact that there are so many shorts on the euro could actually be positive for the currency, because it's telling us that investors are already positioned quite negatively against it. So whenever we have a positive shift in either headline news or fundamentals, the common currency can benefit disproportionately because of the way the market is positioned. Beyond that, I believe that most of the damage that euro has suffered from the Greek debacle is already priced in, and that markets' view on how much the dollar could be underpinned by Fed outlook is excessive. The Fed will not move this year. It's only gradually unwinding some of the extraordinary liquidity measures and not really tightening. So I think that the euro is poised for a bounce back, and I expect it will be trading at 1.40 by the end of the first quarter.
Dariusz, you know, there's an interesting column being written by George Soros in the Financial Times in an opinion column. He writes that the problems that we're seeing in Greece reveals an underlying flaw in the construction of the euro as a currency. And in this entire process, we've heard a lot of people call or talk about the death knell for the euro and the European Union as a monetary union. Can you weigh in on this? Do you think we're actually going to begin to see the beginning of the end for the euro over the longer term?
I would not agree with that. The euro is a political project that is driven by ambitions of the biggest European economies whose leaders want to be able to speak on the world stage on par with, say, the US and China, and they cannot do it on behalf of France or Germany because these countries are not large enough. So for them, it's really important to be able to speak on behalf of the European Union, or at least the Eurozone. And for that privilege, I believe they are willing to pay a fiscal price of supporting the weaker Eurozone members. So I think that the euro will survive. Its credibility has been damaged by the fact that there is always the risk that what if Germany and France doesn't finance Greece or Portugal, maybe the currency will break up. So it's more difficult for China, say, to diversify into the euros away from the dollars now, but the euro will survive and will bounce back.
Dariusz, how closely are you monitoring the debt management situation in the UK? Because from what I've been hearing, if the Eurozone sovereign debt crisis does spread to envelop the UK, then it becomes a serious case of systemic risk for the global economy and markets.
I'm not really focusing on the UK economy and finances, but clearly the very high level of deficit as a percentage of GDP this year is a major concern. Luckily, the UK has an independent monetary policy, unlike Greece or Portugal, and this can provide a way out of it, which obviously would be negative for the pound, but could save the country's fiscal situation. There is always risk for the image of sovereigns if a big one is in doubt, which would be the case in the scenario you're describing. But I don't think it will be something that will actually create a new global crisis.
Yeah, well, we do appreciate your time and your comments. Thank you so much for joining us. Dariusz Kowalczyk, Chief Investment Officer at SJS Markets.